Well, good morning, everyone. Thomas Montgomery. It's a beautiful Monday morning. Today is Monday, January 12th, 2026. We get together most weekday mornings. Today, we are going to continue the trend of our recent discussions since we're in January, the first month of the year. This is a common time when many of us, myself and you included, most likely, are thinking about the year ahead. We're thinking about the year of 2026 and what are we going to each do in our own personal economy to build our wealth, to plan for retirement, to accumulate assets, to grow our income? So I suspect many of you probably are still looking at what is your plan for 2026? You look back at last year, 2025. Did you meet your goals? Did you exceed your goals? And what are we going to do for the year coming up? So, with that being said, we're going to talk about the concept of debt buying. And if you read Forbes magazine or many of these other business publications, debt buying is commonly being referred to as one of the best sources of passive income. So we'll just do a quick show of hands or yes or no on the Q&A. How many of you that are on the live Zoom today are familiar with debt buying? If you could just respond yes or no. I'm just kind of curious of our audience today. So we have 524 of you on. If you could just respond yes or no. Are you familiar with debt buying? And again, as we go through discussion today, if you have any questions, comments, concerns, feel free to type it in. Well, let's assume that you're not real familiar with it. So let's start with a description or a definition. What is debt buying? Debt buying is the practice where a person or a company, so in other words, you don't have to have a company, you could do it as an individual, purchases past due or charged off debts from the original creditor, often like a bank, a credit card company, or a hospital. And we buy those past due or charged off accounts for a fraction of the value. So let's stop there. So we're buying assets. And that's pretty common. When you're thinking about wealth creation, Robert Kiyosaki, Rich Dad, Poor Dad author, and so forth, normally one of the more routine ways of building wealth is to buy assets, real estate, stocks, arguably cryptocurrency. Here we're talking about a different class of assets. These are past due or charged off debts. Now, some individuals will look at this and say, well, that doesn't make sense, right? If these are debts from people that are not paying their bills, it's worthless. Well, if you were to go out and buy current active debts, that's called factoring. And when you get when you enter into a factoring relationship, you're often paying 70, 80, 90% of the value of the asset. So it's still a discount, so there's still growth, profit that can be made. Here, when we're looking at past due or completely charged off debts, we're able to get these for often just pennies on the dollar. So think about that. If you could go buy a piece of real estate for a penny or two on the dollar, let's say it's worth $1 million, and you could buy that piece of real estate for 10 or 20,000, would you do it? Sure. A lot of people go to these tax sales on the courthouse steps and buy real estate for pennies on the dollar. So anytime we can get an asset at a reduced price, it's worth considering. As we understand more, what happens then is the debt buyer assumes ownership of the debt. So the past due or charged off debt was originally with a bank, a credit card company, hospital, the originator of the debt. But the debt buyer in this transaction takes over ownership and then wants to collect the full amount owed. So again, just because someone has not paid their bills doesn't mean that it's uncollectible, but it just means that they've not paid it. So we're able to often get it for a highly discounted amount. When it comes to the collection of that amount, The debt buyer could do it themselves, but that's less common. Usually they're going to use a licensed, bonded, and insured collection agency, someone that has the expertise in collecting debt. What's really great about debt buying, in addition to buying it at a very low price, collecting it, and making money, is this last sentence. And this might have the most relevance to many of you who are our affiliates. So when the debt buyer buys the debt, that acquired debt is now placed on their balance sheet and can be pledged as collateral for loans. So, tying this back to our business financial literacy, we've talked about the three C's. If we want normal business funding, we need to have credit, business credit. We need to have capacity, the ability to pay back the loan. And then we also need collateral. This is a way that businesses can get collateral for just pennies on the dollar. That collateral is placed on their balance sheet, allows them to go ahead and qualify for the loan. Plus, it can also be collected, it can be liquidated. So that's what debt buying is in summary. The next topic is what's the difference between debt buying and debt collections? And it is important to understand the difference because you could be one, both, or of course, neither. So, debt buyers versus debt collections. The main difference is who owns the debt. A debt buyer, kind of as the term refers to, the debt buyer is now the owner of the debt. If you didn't own, or if the person or the business didn't own the debt, it can't go on their balance sheet. You can't put someone else's asset on your financials. It has to be your asset. So, debt buying is the concept of getting the debt, whereby debt collection is usually the party that is going to go collect the money on behalf of the debt buyer. So, could you be both a debt buyer and debt collector? Sure, that's less often the case. So, normally the debt buyer is the owner, and then normally they have a debt collector collect the money from what's called the debtors. So, the debt buyer is the creditor in the terminology, and then the person that owes this money is called the debtor. Now, for some of you, this is going to be really foreign. It just didn't make much sense. A lot of us have been debtors. We borrow money to buy a car. We borrow money to finance a home. We have credit cards, so we're the debtors. This is switching the role because we're not going to become wealthy by just owing other people debt. That's not going to work. But by being the creditor, where other people owe us money, if we turn around and collect it, can be very profitable. And that's the concept of debt buying and why it's getting so much attention. Now, I will tell you that historically, debt buying has only been done by very large institutions. And we're going to give you a case study of one so you can even look it up after our Zoom if you want. But before we get to that, the next question is debt buying profitable? Because again, some people see, well, if these are past due or charged off debts, it's worthless. Well, no, it's not worthless. Now, it's not worth as much as, let's use two examples. Let's say that you were in the business of buying mortgages. And if you could go buy an individual or a block of mortgages of people that are currently paying their mortgage every month, that would be the most certain source of income because these are people that live in the home and they're paying their mortgage every month. And you might have bought a home where who owned your mortgage or who was servicing the mortgage changed roles. But again, those types of transactions, you're often paying 90% or more of the face value of the asset. So it takes a lot of capital to do that. In contrast, when we buy what's called non-performing debt, either past due or charged off, we can typically get those for just pennies on the dollar. So for those that we do collect, the ROI is crazy good. So the question is debt buying profitable? Absolutely, it's profitable. And if you think about it, it's almost impossible for it not to be profitable because we're getting assets at such a low rate, pennies on the dollar. So let's go ahead and take a look at Encore Capital. Encore Capital is a publicly traded company. You can go on the NASDAQ exchange and look them up, ECPG. That's their trading symbol. They generate billions, not millions, but billions of income. So Encore Capital is kind of how we built our model off of. They just operate on a very large scale. So they'll go to like MasterCard and get tens of or hundreds of millions of dollars of non-performing debt. So when they're getting portfolios, they're getting massive sized portfolios. And that's what's normally been done in the market is really large portfolios. What that's done is it's left the average person out of those transactions because who can afford to go buy hundreds of millions of dollars of non-performing debt? Not many people can, not many companies can, but publicly traded can because, of course, they're using investor income. So this just gives a quick snippet of Encore, which we're not involved with Encore. I'm just using it as an example of one of the biggest or the biggest in the market. So they purchase and then collect charged off consumer debt in the US and Europe. The graphic shows the process. So the consumer debt is issued. So this is someone that gets a car loan, a mortgage, a credit card. But if they don't pay, then it becomes charged off. And then the issuer, like Capital One Bank, I was giving an example, they sell that charged off debt. They would have preferred that the client pay them back, but when they realize the client's not going to pay them back, a lot of those companies just sell off the debt and just take a loss. Well, that's where Encore comes in. Encore comes in and purchases and then collects that charged off debt. And that's similar to our model I'll describe to you in a moment. So again, very legitimate, very credible. Maybe it's new to you. Maybe it's something you're not familiar with. I'd say about a third of you said that you have done debt buying in the past, and about two-thirds of you said that you haven't. So there's a difference, of course, if you have a frame of reference or not. But with that being said, let's continue on and talk about what type of results they get. Because again, these are non-performing debts. If you were to acquire performing debts, it'd be very expensive. Non-performing debts can be acquired at a significant discount. So if you look at the industry, normally debt buyers are able to collect around 82 to 84% of the face value of the debt. And of course, they're getting that for pennies on the dollar. So when you start to compare your ROI, right? Most sophisticated people like all of you, anytime there's a financial decision, you're typically trying to calculate your ROI, your return on investment. So if you could buy a dollar of debt, let's say for a penny or two, and then turn that into 82 to 84 cents, is that a good ROI? Oh my gosh, of course it is. It's not a double, it's not a triple, it's more, it's an incredible, almost an infinite ROI. So I don't think that many people, and that's why again it's getting the recognition that it is in Forbes magazine and elsewhere. I don't know that there's many other places that you can recognize that type of return with essentially no risk. Again, for our clients, how this fits into the capital raise process is that if you're one of our affiliates, you'll probably run into people that they want to borrow money that is greater than what they qualify for. In other words, they have a collateral shortfall. They want to borrow $1 million. So then we evaluate, well, do you have $1 million of collateral? Now, some lenders don't require collateral, but some do. So then we assess how much collateral they have based upon what assets their business has, and then if they want to contribute personal assets. If they, between their business and personally, don't have enough assets to be to collateralize the loan. That's called a collateral shortfall. And we can literally transfer those assets for pennies on the dollar. And then, as we mentioned, put it on their balance sheet, use that for the collateral for the loan, and turn around and go liquidate it, collect it for them. All right, so as far as action steps, and then we'll open it up for questions, comments, concerns you have. I think you see the trend. What we do, you and I, what we do together is we help legally and ethically create fundable businesses. And that comes down to making sure they have a good business entity. If they don't, we provide them a shelf corp. And then it comes down to the three C's. Business credit. If they don't have it, we add trade lines. Capacity. Do they have the demonstrated ability to pay back the loan? If they don't have that, we can put together projections and we can also put in daily deposits into their account. And then thirdly, which is our topic today, collateral. What can we do with collateral? We can transfer them collateral and they don't have to have any money out of pocket to get that collateral. So let's go through those steps. How can we make money as a debt buyer? Now, again, if you have clients that are a little bit more simplistic, they're not going to think about debt buying. They're going to just think about, hey, I want a loan and they need the collateral to resolve their shortfall, which is fine. But they may be overlooking the fact that that collateral can then be, in the form of AR, can be collected and turn a tremendous ROI. So, through the grant we received, we position individuals to become debt buyers, but we do this with small debt portfolios. Again, there's the players like Encore Capital, but they're up buying 100 million or more portfolios at a time. Well, the average entrepreneur can't afford that. So we break the portfolios down as small as 20,000. So it's a much more attainable strategy for average entrepreneurs. So to do that, if you have a desire, so this can be either a strategy that people use standalone. We have two individuals that I believe this month, in the month of January, are to be flying in, and both of them have expressed an interest in buying $50 million or more of receivables and then having us liquidate those. So the point is, some people want to do this just as a standalone to be a debt buyer. Probably most likely in your and my joint world, most of the people that you and I work with will want the collateral to qualify for the loan. That's their primary motivation. But the point is, some people will just want the debt. They're not worried about getting a loan. They just want the debt and then to collect off of it to generate the ROI. All right, so what are the three steps? Real simple. First of all, give us a call and let us know, and we can get you set up as a debt buyer. We'll find out what size of portfolio you want. Normally we do $1 million portfolios, but we can go down as small as 20,000. And then we can get that transferred to you typically in one business day. And it's designed to be no out-of-pocket cost. And you see the little asterisk. So what I mean by that is we can get financing in most cases, so we can transfer the assets to the client so they become a debt buyer, but they don't have to pay anything out of pocket. That's the design of it. So that's step number one. We have a licensed, bonded, and insured legal collections team that's going to go turn around and then collect that debt. So we have passive income coming in. Of course, we're able to put the debt on the balance sheet right away for collateral, as we talked about earlier. And the end result is the debt buyers start seeing those deposits coming in with really no work, no time, no effort, and really no risk because we're getting it for pennies on the dollar. So let me summarize and then we'll open it up for questions, comments, concerns. One of the mandates of our grant we received is to help build financial literacy. And so our morning sessions are often focused on that. And so today we're looking at one of the credibility factors that most lenders require for getting a business loan, which is to have adequate collateralization. I believe you'll commonly run into people that don't have adequate collateral. Therefore, what can we do about that? Well, we can either bring their loan amount down to the amount of collateral they have, or more often, we can increase their collateral up to the amount of loan that they're requesting. When we do that, they may not be thinking of this, but they're really becoming a debt buyer. Just like Encore is a debt buyer. They're doing something that's real, it's significant, it's profitable, and it's passive income. So yes, they're getting the assets to put on their balance sheet so we can move forward with the loan, but also they have this big asset that is then allowing them to start recognizing the benefits of the money being collected and put into their account. Who has questions, comments, concerns on our topic today, which is debt buying? All right, Gilbert has an interesting question, and I'll bring that up. So Gilbert's a little more sophisticated than some of us. So Gilbert understands that lenders look at balance sheets of businesses. The balance sheet represents the assets and liabilities of the business itself. Some people aren't quite as sophisticated as Gilbert, so that some people say, well, it's a new business, so I don't have any assets. That's fine. Well, no, that's not fine. Even if it's a new business, we need to have collateral for the loan. And so typically the first place the lender will look at, as Gilbert suggested, is the balance sheet. And we've kind of addressed that. I think the other point that Gilbert's making is that in many cases, lenders will also look at the PFS, personal financial statement of the business owner. So the balance sheet shows assets and liabilities of the business. The PFS, and we've had trainings on those, maybe we need to have another one, but the PFS, personal financial statement, shows the assets and liabilities of the business owner. And so it's good to have a strong set of financials, both for the business and individual. Gilbert's point specifically is yes, we can, in fact, put these assets either on the business to build the balance sheet of the business, or we could put these assets on the PFS, the personal financial statement of the business owner, and it improves their net worth. And we've had a couple of you do this over, well, mainly last year. I don't know that we've done any this year, but it's where you wanted to be a millionaire on paper. So how could we have 538 of you on right now? So how could any of you become a millionaire legally and ethically on paper in 24 hours? Is it possible, or is that a scam? No, it's perfectly possible. So, how would we make anyone a millionaire on paper? We need to legally add assets to their PFS, their personal financial statement. Well, could you go buy $1 million of real estate? Well, sure, but you'd probably have to pay $1 million to get $1 million of real estate. So if you had to go borrow $1 million to get $1 million of real estate, you haven't increased your personal net worth at all because there's an equal trade-off. Sure, you have a new asset worth a million, but you also have a new liability to pay for it worth $1 million. So you've not moved your PFS at all, your personal financial statement. In contrast, being a debt buyer, we could go buy $1 million for a penny or two on the dollar, really inflate legally and ethically the worth, the documented net worth of the individual person by adding all of those assets on. And then, of course, I see what Kenneth is bringing up. What if they don't have the financial liquidity to get the assets? That's the whole point, Kenneth. In most cases, people don't need to pay anything out of pocket to get these assets transferred. We can get financing for that. So, yes, in summary, being a debt buyer can improve your financials if you're an entrepreneur, can improve your business financials, the balance sheet, can improve your personal financials called the PFS, the personal financial statement. And then we can turn around and liquidate, collect the receivables and turn that into cash. And of course, what are the benefits of cash? Well, when we have cash coming in, that improves our bank accounts, our bank statements, our profit and loss slash income statements. So the assets itself can improve our asset side of the financials, but by liquidating them, then we can turn those assets into cash, which improves our liquidity. Hopefully that helps. Okay, Cameron asked a question, which is a good one. So to get I'm going to paraphrase. To get business financing, do you have to have collateral? No, no. Not all types of financing require collateral. Some do. Traditional loans do. Normal business loans do, Cameron, because it makes sense, right? Cameron's very sophisticated, but let's say that Cameron wanted to get $1 million loan from a bank. And so that bank is going to say, okay, Cameron, what are you going to do with $1 million? Can you afford to pay it back? And if you don't pay it back, what are you putting up for collateral? And so normal loans do require collateral. It's one of the three C's that we talk about all the time. But there are some types of financing that does not require collateral. So, and that's generally the rule we've talked about. There are three C's: collateral, credit, meaning business credit, and capacity. For traditional loans, we need all three. However, there are some outliers, some niche sources of capital that only require one or two of those three. Eduardo asks, where can we find the market for this type of business? Well, we're not here asking you to go find debt buyers. We're more so attempting to educate you, Eduardo, that A, here is how we can provide legally and ethically collateral for entrepreneurs to qualify for a loan. And then secondly, it's not just getting them assets to qualify for the loan. They are now a debt buyer, and then we can liquidate those debts and turn that into cash and start getting them those daily deposits. And they don't have to have any out-of-pocket expense. They don't have to put any time or effort into it. So again, for some of you, like Eduardo, this all is, just, like the back of your hand. But don't think that everyone has your level of financial literacy. A lot of people have never heard about debt buying. They don't know how it works, and that's why we've addressed it. But certainly, if you're one of our affiliates and you're out helping a client enroll to get a free funding proposal, which is the primary thing that affiliates do, we will be looking at their three C's: credit, business credit, capacity, and collateral. And if they do need collateral, which not everyone does, but if they do need collateral, we can assist them with that. All right. Cameron's asking about the turnaround time for liquidation. So we've made some significant changes this year, which I realize we're only 12 days into 2026, but we've made some significant changes into how we go about doing the liquidation. So, first of which, we have a truncated or a shortened process where from the time the account begins being worked until the lawsuit is filed, if the person doesn't pay, we're going to litigate. We'll be over at the courthouse today filing. We file 20 to 100 lawsuits on most days. We'll be filing 40 lawsuits, 40 today. So part of what we do to help collect the money for the clients is to first ask the debtor to pay. And then if they don't pay, then we send them a demand letter. Then our attorneys draft up the lawsuit. We offer them one more chance to settle. And if they don't, then we actually file the lawsuit. So we've shortened that whole cycle down to a 7-day process. And then we're also working with a new collection agency that's doing a lot of this work for us that has more capacity than what we had. So the process is working really well. So if you know of anyone that would be interested in being a debt buyer just simply by owning the debt and us turning it into cash, then that's a resource. Alternatively, if they need the debt to build their balance sheet, we can do that as well. And we do that almost on a daily basis. But again, as I mentioned as I close, we have a couple debt buyers coming in this month that are buying 50 million or more portfolios, and their purpose is not necessarily to get a loan, but they see the value of getting assets for pennies on the dollar, just like Encore does. Any other questions, comments, concerns? Again, if all you are is an affiliate, really what you need to focus on is helping people get free funding proposals. You get paid 5% of the capital raise. You really don't need to know all of this, but many of you have a thirst, a desire to learn more about what's the mechanics behind the scenes and what makes this work, why we're able to guarantee any client a large capital raise, which we guarantee in writing, is because we legally and ethically help them become fundable. There's 3 C's, and we assist them with all 3 C's. This is how we assist them with the collateral. All right. Well, thank you much. I'll see you all tomorrow. If you have any questions, comments, concerns, certainly give us a call on the office line and we can assist you further. Have a great day. Hope to see you on tomorrow's Zoom. Bye-bye.